Continuing on, two parts. And share screen. And we're back in business. So sorry for the technical difficulties, but we're back online.
The income is the company generating relative to how much stockholders' equity that it has. Abercrombie and Fitch, as you would probably guess, they're not generating a lot of net income, only that $4 million. So they're only giving their stockholders a return of 0.3% in that 2017 year. In 2018, not much better because net income is still pretty low, and it's only 0.6%. A little hint for trying to remember these formulas: whenever you are involving a ratio that has both income statement and balance sheet in it, you're going to average the balance sheet. If it's only income statement in the numerator and denominator, or only balance sheet in the numerator and denominator, you're not going to average. So it's when you've got both income statement and balance sheet that you're going to average.
Oh, that's good.
Yeah.
Thank you. That's a new.
So we talked about taking, whenever we do inventory turnover, we have an income statement item, cost of goods sold, and we have average inventory. Receivables turnover, we have sales for the year and average AR, because it's 2 points in time. And they're the same thing here. We're going to take average equity or average assets for return on assets and return on equity, because the return is for a full year, and we're going to take the average during the portion.
Go on, yeah.
It's a tip. So, American Eagle, again, they had healthier net income, so we're going to expect that they are providing more kind of return to their shareholders. 18.8% in 2017, 16.7% in 2018. So it went down partially because they made less income, but then also because they just had a higher shareholders' equity, so they weren't providing as strong of a return.
That's still a pretty good return, though. If you were one of those people who originally contributed equity and that numbers and your numbers included in there, and you're earning 18.8 or 16.7% on that, that's pretty good.
Yep, no, definitely is good. So the higher is better. Abercrombie is improving, but those numbers are just tiny. American Eagle is certainly throttling them in this category, even with their dip in 2018.
Who are you leaning towards so far?
Who am I leaning towards? So it's got to be American Eagle. They're making money.
They're making a lot more money.
Yeah, bottom line. So that's what's happening. So all right, I'll throw it back to you.
All right, let's next talk about return on assets. Very similar to return on equity, except for in our denominator here, we are using average total assets as opposed to average equity on return on equity.
Average
I'm
assets.
kind of glad accountants aren't that creative in their names for these ratios
That's right.
at this
It helps
point.
us remember it.
All right, so if we look at 2017, again, with that lower income for Abercrombie and Fitch, you're going to have a little bit lower return on assets, 0.2%. And then with a increase in net income, that's good, but we see their assets also increase a little bit in 2018. So we have a limited increase in return on assets of 0.3%. So we see some improvement there, which is nice, but
so tiny, it almost doesn't matter.
Exactly, it's 0.1%. So let's look at American Eagle, who has a higher net income and, as you see, lower assets, meaning they are more efficient as far as generating income with the assets that they have, 12.5%, which is obviously much better than 0.2%. And then in 2018, where assets did increase a little bit and net income went down, so they're only at 11.3%, which isn't as good as 12.5%, but still much better than the competition. So if we finish up with this analysis tab here, return on assets, you want a higher return on assets. It's a great metric to see, are you able to efficiently use the assets that you have to generate a net income, bottom line, after all your expenses and everything? And American Eagle is doing a much better job of this than Abercrombie and Fitch.
Yeah, and this one tends to kind of trend similar to how return on equity trends. So American Eagle, a little bit easier to see in that the return on equity for American Eagle was down in 2018 compared to 2017. But the more efficiently a company uses debt, the higher that its return on equity will be compared to its return on assets. In theory, if a company did not use liabilities or debt at all and got all of its financing from its owner, return on assets and return on equity would be the same. So the kind of the spread between return on assets and return on equity is how effective is the company in using its debt. All right, well, the next one, total asset turnover, and this is where I'm betting we're going to see American Eagle do better, just because if it has lower profit margins, lower gross margins than A&F, it's got to beat them somewhere, right? Well, Abercrombie, we can look at this one, net revenues over average total assets. So they're sitting there at 1.4, all right, when we take their revenue divided by average total assets. And then the next year, their revenues are up by a little bit, and their average assets are actually fairly flat there. So they're 1.5%. So not a lot of movement. I shouldn't say 1.5%. It's just 1.5 times is what that is. Now, American Eagle, let's see if my hypothesis is right. Yes, they have a 2.1 asset turnover in 2017. They have higher revenues but lower assets, similar to that point.
By the way, you can have a negative return on assets or a negative return on equity if you have a negative income or have a loss. So if the numerator is negative, you now have a decrease or a loss and a negative return on your assets as opposed to a positive return on assets or return on equity.
You made before about return on assets. And then in 2018, the revenues go up, but the assets are up a little bit as well. So it stays similar at 2.1. But this is how American Eagle is doing. This is a big area that they're doing better than Abercrombie. And higher is better. Abercrombie is slightly better, but American Eagle is doing considerably better. A company like Walmart or Costco, this is how they win, right? They do not have huge margins, but they have fantastic turnover.
High turnover, just getting people in, making a little bit off of everyone, and that adds up.
Sell a bunch of stuff.
Sell a bunch of stuff. All right, that works.
Yeah,
cool. All right, so let's move on to days receivables. So with this ratio, we are going to first calculate our receivables turnover. And that's this part you see on the right here, net revenue divided by average accounts receivable. And what that tells us is, okay, here's the revenue we made during the year divided by what was our average accounts receivable balance, which gives us an indication of how many times did we collect those receivables in a given year. That's what we mean by receivables turnover. Now that number by itself isn't really particularly useful at all.
Yeah.
And so we're going to improve it by taking 365 divided by our receivable turnover to put it in days. And then it's say, okay, it's taking us X number of days to collect. That's good. It's better than last year. It's worse than last year. It's better than our competitors, worse than our competitors. But then it's easier to analyze that way, just in your mind to think about efforts to improve collectibles. So if we look at this for Abercrombie and Fitch for 2017, we're going to start by taking 3,326, their 2017 net revenue, divided by receivables in 2017 plus receivables in 16 divided by 2. That's how we get our average receivables, just a simple beginning plus end divided by 2. So 365 divided by that turn is going to give us 8.2.
So on average, it takes them 8.2 days to collect their receivables. How they do in 2018?
That's not too bad though, right? 8.2 days. Like,
Yeah, and it's not super applicable to this industry because they sell more in cash. This would be a lot more applicable to an industry where they're selling more to other businesses.
Yeah, but they're still going to look at that just to see. And so if we look at 2018's number, they were at 9.0. So they got actually a little bit worse.
Yeah,
It took them 8 days. Now it takes them 9 days. Are you concerned, Buzz? As a potential investor?
No, not for this company. This one isn't a big one. Let's still compare it to American Eagle just to see how they did.
No, I just want to quit.
You just want to quit.
No, I'm not going to do it. So again, American Eagle for 2017, we take 2017 revenue divided by 2017 ending AR plus beginning AR over 2 to figure out the average, and they get 8.5. And then if we look at 2018, they're at 7.9. Hey, American Eagle looks like they're improving.
Yeah,
They're getting better.
Yeah, and let's just clarify on that one then. So lower is better. We want to collect our receivables more quickly. So Abercrombie, they got a little worse last year. American Eagle got a little better last year. So yeah, Abercrombie is a little bit worse, but these are still pretty close, and this probably isn't the most significant ratio to look at for these type of companies anyway.
Yeah, taking 1 extra day isn't necessarily
one extra day is good.
that big of a deal in the
That's
scheme of
right.
a
No, not
multi-billion dollar
invested.
business.
That's
It takes them 1 more day to collect.
Yeah, but
All
this is this is a big one for service businesses that provide a lot of services on account. As an example, this can make a huge difference for those type, or just
Actually, manufacturers too, where they're purchasing raw materials, so they got the accounts payable clock that's ticking for them. They're trying to generate the actual cash to pay back.
like General
for the
Mills used to be a
purchases.
client of yours, right?
Yeah,
So
absolutely. So they would watch this a ton, where they would say, how long is it taking us to collect? So they would try and reduce that days receivables as much as possible, so they're collecting sooner, hopefully in time to generate enough cash to pay back their suppliers that they had to borrow from initially in order to purchase the materials.
Exactly, and certainly you could eliminate this altogether by not selling on account at all. But then that would
Then you lose some customers potentially.
It's a balance.
Yeah, a lot of big businesses have decided that it's worth it to sell on account to get those customers. So,
Sure.
Similar,
Probably a bigger one is the days inventory side of things. So the concept here is the same. It's going to be 365 divided by turnover, but in this situation, it's inventory turnover, not receivables turnover. So we've got cost of goods sold in our numerator, average inventory in our denominator. That gives us our inventory turnover. How many times during the year do we sell our inventory? And again, 365 divided by that, how many days on average does it take us to sell our inventory?
Yeah, I like to think of this one, and it doesn't really fit, but just in my mind mentally, the turnover piece is like we're filling up our warehouse, right? We're getting it filled with goods, and then how long does it take us to empty it out and sell it? And that would be 1 turn, and how many turns we get, 365 divided by that would give us our days. So.
Sure, exactly. So in this one, we've got our cost of goods sold up top. We're going to divide it by our average inventories down below. So the 1.29 billion, and then the average inventory is 399 million and 436 million. And then when we do that, we see that it will take them 117 days to sell their inventory. That's kind of a lot,
Yeah, I mean, we're going to compare it right now, but just at first look, 117
4
days
months
with way fashions
average.
change and clothing change. You're Abercrombie and Fitch trying to figure out the right sizes and quantities to make it's kind of a long term.
This would be bad if it was a grocery store.
That would be very bad.
Fresh produce, that's right. But we can compare it. Did they do any better in 2018? We'll take 2018 sales over 2018 and 17 inventories, and they got 10 days better. I mean, I wouldn't doubt if that's something they looked at as a company and said, our days inventory is huge here. It's taken us a long time to sell. Let's try to make some efficiencies. I wouldn't doubt it. In 2017, American Eagle, same concept, COGS over average inventory, only was taking them 54 days to sell.
That's a significant advantage.
It is.
17.
Yeah, and I'm sure Abercrombie looked at that, and they said, okay, why is their days inventory so much lower? Is there something we can do differently?
And think about all the costs too associated with storing that inventory for Abercrombie.
The
warehouse security. And
you mentioned styles. It can go out of style. It can
There's
get
a lot of risk
stolen.
associated with that.
It can go out. It can go obsolete. It can get fire. Anything like that. And then American Eagle in 2018. Who knows? Maybe they looked at Abercrombie and said, "Wow, we're way better than them. We can relax a little bit." And they did get a little bit worse in that regard. But they're crushing Abercrombie because here lower is better once again. So Abercrombie, they're performing better than last year, but much worse than American Eagle in both years.
So in this case, I'd be more excited about American Eagle.
Exactly.
All right, so next one, earnings per share. This is probably the single most watched ratio by analysts, I guess anywhere, I would
agree
say.
with that.
You take the net income, but instead of just having the raw dollars from net income, you divide it by the average number of common shares outstanding. So that gives you a sense of if I buy 1 share of stock, what piece of that net income would be allocated to me. It doesn't mean you're going to get that, but it is a nice way to compare companies of vastly different sizes just by looking at how much income do I get for every share that I own. And so if we look at this for Abercrombie and Fitch, you can see in 2017, hopefully that net income number is getting pretty familiar to you, 4.0 divided by around 67.5 shares outstanding gives us earnings per share of 0.06. This is not very good. It's pretty low. In 2018, we can see do they have any sort of improvement, and they're only at 10 cents per share, which again is still pretty low. So having that really low net income really drives down earnings per share, and they're probably going to take a pretty big hit as far as their market price goes as a result of that. American Eagle, if we look at them, a lot higher net income, 212.4 over 181 shares outstanding, gives us $1.17, which again, this varies a ton across industries, but that's pretty good, at least relative to Abercrombie and Fitch. And then you can see here in 2018, they're at $1.14. So we do see a decrease. Probably not excited about that. Analysts probably don't like that. Share price goes down, but still better than Abercrombie and Fitch.
Yeah, and usually if net income goes down, earnings per share will go down. Not always, because sometimes if a company buys back some of its shares, the shares would go down by more proportionately than the net income.
Yeah, and so Abercrombie going up, we're happy about that. American Eagle going down, we're not happy about that. But Boz, you don't like to compare across companies with EPS. Why not?
A company can choose how many shares it wants to have outstanding. So, and some companies will just decide to have a lower or higher number of shares outstanding to kind of manage its share price a little bit more. Berkshire Hathaway, their share price is probably a couple $100,000 right now. So wherever their earnings per share is at,
$400,000.
I mean, I don't know that off the top of my head, but if they did a stock split and just a 2-for-1 stock split and suddenly had twice as many shares, that would impact their earnings per share, but really not, have any measurable impact on the shareholders of the company. So it's based on how many shares you choose your company to have.
And when I was out at General Mills, we were talking about them earlier. They had an active strategy where net income was roughly flat over a number of years. So to increase earnings per share, they were repurchasing a lot of shares into their treasury, which reduces the number of shares outstanding. So driving EPS growth that way.
Yeah, I mean, you could set up a company and make $5 drink a honey or something like that, right? And just choose that your company has one share, and that so then you have $5 earnings per share.
I thought you said we made $1.
just play with me here.
Okay.
So Drink a Honey has one share, makes $5 earnings per share. Does that mean that you are better than Abercrombie or American Eagle?
I have a higher earnings per share.
Higher earnings per share, right? So yeah, it just wouldn't be applicable if you had 70 million shares outstanding or 180 million shares outstanding like those two companies. Your earnings per share wouldn't be so high. Anyway, where we can use this in order to compare across companies a little bit more is the price earnings ratio. So what is the market price per share, the stock price per share, divided by earnings per share? So for Abercrombie, we looked up the market price per share, and it was $21.12. And again, on the previous slide, they made a dime per share. So in that situation, they have what's called a PE ratio of 211. So as if Abercrombie just continues to make a dime each year, it'll basically take them 211 years in order to repay their shareholders.
That seems like a long time.
It does. So we'll get to that in a moment, why that is then. American Eagle, this is a little bit more classic. So $24.83 per share. They made $1.14 per share. And they have a PE ratio of 21.8. Now, if we look at this one, the analysis, the higher, it's not that higher is better or worse. It just implies generally that investors believe that the company has higher growth prospects,
Potential.
Particularly with Abercrombie. They had a couple one-time items impact their net income. So investors are really counting that those one-time items are not going to repeat themselves. So they have a lot higher growth prospects.
Basically, Abercrombie and Fitch, they've inspired enough confidence in investors over the years that with a couple of off years with some big expense items, their stock price necessarily isn't just going to tank where everyone loses faith that they're going to stay up there and not be able to generate income anymore.
Yep. So this ratio here, you really like this ratio. This is kind of the great equalizer, right? A lot of the other ratios drive this one.
So what I love about this one is that you can make an argument with Abercrombie and Fitch, say, yeah, it's 211.2, it's really expensive, but it's expensive because it's such a high quality income, right? I have enough faith that they're going to generate income that I'm willing to pay a high price right now, knowing that income is low, but I have enough faith that it's going to go up down the road. So I could make you a very convincing argument why Abercrombie and Fitch is better, right? Higher quality. On the other hand, I could also make a very convincing argument that American Eagle has a better PE ratio because it's such a better deal. It's so much cheaper. It's only going to take me 21.8 years to earn my investment back versus
no growth, which isn't the case.
Versus 211.2. Like 21.8 is such a better deal. I don't know how much faith you have in Abercrombie and Fitch, but being able to earn that back in 21.8 relative to 211.2 just seems like a much better deal, a much safer bet for me.
And we'll pull this one back on the summary slide as well. We go on to the next slide. Is this one's yours, isn't it?
I think so. I kind of lost track a little bit, but current ratio. This is, a pretty quick hitter, I guess. A lot of companies look at current assets over current liabilities to get a sense of do they have enough available in current assets, things are going to turn into cash in a year, to pay all their current liabilities. And as we can see here with Abercrombie and Fitch, they're at 2.3 in 2017 and 2.5 in 2018. So what this means is that 1.0 would be, break even just enough. They're more than double that, so they're fairly safe, I guess. I would use words like aggressive versus conservative here. Some highly established companies that are really, really good at cash management and investing excess cash into the business, longer term assets, they'll have current ratios even below 1.
Like Walmart
sometimes.
has 0.8, I believe, is where they where they've historically sat, and that means they have more current liabilities. So stuff they got to pay off in the next year versus current assets, stuff they expect to be cash next year. That does not mean Walmart's going bankrupt.
No, it does not. They're just very aggressive, and they can generate the sales or generate the cash through their sales to pay off the liabilities as they come due. Whereas Abercrombie and Fitch is a little bit more conservative. If sales do, fall through for whatever reason, they have enough in current assets to cover their current liabilities.
I look at that. I mean, they're not going bankrupt in the next year. Is one quick.
You've seen this
conclusion.
one
If the
before.
company had a current ratio that was like 0.1 or 0.2, and they're not profitable or whatever, I would be really concerned that they'd be teetering on the verge of bankruptcy.
Yeah. So let's move on to American Eagle. In 2017, they're at 1.8, and in 2018, they're at 2.0. So a little bit more aggressive here. I'm not going to argue that one is better than the other. You could say American Eagle is more risky, but maybe you're looking for a little bit more risk. That could mean they're more heavily invested, I guess, in their business to focus on growth, whereas Abercrombie and Fitch is more focused on just, I guess, remaining consistent. I don't know a better way to say that, probably.
Sure.
So Abercrombie slightly more conservative than last year and more conservative than American Eagle.
And I think this is one of the most common ratios where people, in my mind, would get it wrong. I think a lot of people would say Abercrombie is better here. That's not the case because American Eagle's not going bankrupt anytime soon. I mean, the extra current assets that Abercrombie has, it's not like they're free. They had to pay for those assets somehow. So they've got extra assets on their balance sheet that they're tying up that way. So in theory, a company wants to keep this ratio as low as possible without having a risk of bankruptcy. I think that brings us to the final ratio. So the debt equity
There's
ratio.
a lot of these things.
There really are. So
and there's even more we're not going through. We're just
That's
picking
true,
some of
that's
the
true.
big ones, the basic ones, get our feet wet a little bit, and then roll in your other classes with some more intense ones.
Absolutely. So the debt equity ratio, this one can be computed a lot of different ways, and you will see this one differently in a finance class, so just be aware this is like an introductory way to compute it for a first accounting class. Total liabilities divided by total stockholders' equity, and in this situation, they have liabilities of $1 billion, stockholders' equity of about $1.25 billion, so they have 0.83. So we can say for every dollar of equity they have 83 cents of liabilities, and that was in 2017. In 2018, it follows a similar trend. They have a little bit more liabilities compared to equity, 0.86. American Eagle.
That seems like a lot to me.
A lot of liabilities.
A lot of debt, yeah.
A lot of debt. So, well, companies grow with debt. Basically, is one of the ways they grow. A lot of that could be, very low interest debt or non-interest bearing debt at all, like accounts payable.
Yeah, debt has been cheap in recent years, so a lot of companies have taken on a bunch of debt just because it is cheaper than equity, they say.
Yeah.
And we're probably getting ahead of ourselves a little bit with this class, but
Sure.
it seems high, and companies don't necessarily view debt as a terrible thing.
Yeah, just like you. I mean, we're sitting in your house in Sartell right now. Did you pay cash for this thing?
Straight cash,
Straight
homie.
cash, homie. Just lying.
I did not, but I just want to say straight cash, homie.
That's right. So, but yeah, you've got debt, right? It's a way that you're able to afford getting into this house or to acquire this asset, just like these companies do as well. American Eagle, they have, as you can just kind of eyeball it, they have less debt as compared to their stockholders' equity. So their ratio is actually 0.48 in 2017, and it's 0.46 in 2018. If we do a comparison, the more debt you have, the more aggressive you are. In general, interest is pretty cheap. So higher debt gives you an opportunity to get higher returns by borrowing at a low rate and then investing at a higher rate.
Somebody
But
else's
the more debt
money,
you have, the more
SEM.
risk you have of going bankrupt. No one has ever gone bankrupt without any debt. Did you know that, Ben? So,
I never thought about it, but you're right. And riskier for shareholders as well, because in the
Yep.
event of a bankruptcy, whoever issued the debt to whatever company, Abercrombie and Fitch, they get their money back first, and shareholders are kind of at the bottom of the totem pole getting whatever's left over. So
Yep.
makes it riskier for shareholders, but potentially greater returns too.
Yep, absolutely. So Abercrombie definitely more risky in this one. Well, if we summarize this all, and I'm going to take the summary too. So there. So
Yeah, no, I was going to ask you to walk us through this thing. We got a lot. We've talked through a lot so far in this PowerPoint. So
Yep. So if we look at these, as far as how they're doing, we're just showing the 2018 comparisons here. The biggest ones that are jumping out is the ones that we say much better. So like the growth, increase in net income. Well, ANF was much better, but that was because it was tiny.
small number.
Yep. That was one of the reasons. So we kind of discount that because it was tiny. And now we go down to the profitability. Profit margin, return on equity, return on assets. American Eagle was much better.
Actually, for a second, who do you give the edge then in growth? Of
Like
those two
the edge
companies.
in growth.
Yep.
So I would actually give
Kind of like
it.
segment by segment almost.
Yeah, I would in this situation. I would give it to the consistent company. So, and American Eagle is the one that's been more consistent.
5% growth in revenue.
Yep. So I would have just given it to them, I guess. So,
Yeah, I would agree with you there.
Yeah. Even though that high number, that 77%, is just an outlier. So, but so the biggest thing's profitability. American Eagle is doing much better here. Asset utilization, we can just see in that situation, American Eagle is also doing better. Just partly they're having higher turnover. They're keeping their receivables and inventory lower. Now the pricing, again, we see the big difference right there. That Abercrombie has a much higher PE ratio, and then on the liquidity side of things, that one of them is more conservative. Abercrombie with the current ratio, American Eagle with the debt equity ratio. So we just look at this, and now we're going to make an investing decision. I mean, if these companies have the same amount of shares outstanding and the stock price was the same, I mean, which one would you invest in at this point in time here?
Oh, American Eagle for sure. If the same shares outstanding, then I see that change in income like we talked about. Not change in income, just the raw dollar amount of net income. I get much more net income for every dollar I invest with American Eagle. But
that profit margin is
but they're
really
not the same is the thing.
Yeah, no, they are. So they have a lot higher profit margins. That would drive it. But you know what? It's not just us sitting here who think that. That's other investors, and that's why their PE ratio was a lot lower. It's cheaper. So if you wanted to invest in someone like that, Abercrombie, due to that lower net income, does have a much higher PE ratio. So question for you. So these companies each.
You were waiting for this the whole time, weren't you?
I was. So these companies are similar in revenues. They're each about $3.5 billion. If I made you kind of compare market capitalizations of these two companies, which is share price times share outstanding, would you have any guesses on that one? Again, they're each about $3.5 billion of revenue.
Yeah, so same size with revenue, but I see that American Eagle has much greater margins, much more profitable with that same size of revenue. So I think they would have a higher market cap because investors would value American Eagle more highly. Basically, can do more with the revenue that they have.
Yep.
But am I right? Or am I wrong?
You are right, and it's about 3 times different. So it's Abercrombie.
I'm going to pause for about, we have 3 minutes left, but I know class is officially ended at 12:20. So I want to open the floor to any questions you might have, and then I'll play the last 3 minutes. But if you need to go, you're welcome to. And again, you can play this back at your leisure. Any comments or questions?
I guess when would we need to be using like the horizontal and vertical analyses?
Through the rest of your life. No. We'll be using it for the projects, and we'll be tested on it as part of this chapter. So we're going to be doing, we'll talk horizontal and vertical on Monday. So I want to make sure you understand how to calculate those and understand how they're utilized. The final projects are due the last 2 weeks of classes, where presentations will be made. So if you have some time and you start your projects, you'll be using it effective immediately. But
Okay, I guess I was meaning like career-wise though. Like once we are they used like a lot?
Well, think about personal investing. Do I want to buy stock in a company? You'll probably do some of your own analysis. Or if you're in a company and you're trying to evaluate which company do I buy from, who's going to be more solvent, who's going to be around longer term, that they can execute their warranty. So you might be looking at the financials of other companies saying, wait a minute, they're going down the tubes. They're losing sales every year. Here is Sears. I don't want to buy from Sears anymore. Or I don't want to buy from JCPenney because they look like they're going out of business. But that's downward trends in sales, downward trends in profitability, negative equity, whatever's going on. These are trends that you will take a look at. So how would you use it? It's not like, when will I use calculus? It's more, well, anytime you're going to take a look at a company and examine even your own company, how are we doing? But even if you're not publicly traded, you still want to know your trends. Are your trends up or your trends down? Where are we? Different product lines. This stuff is selling better. This stuff is selling worse. So the trends here, there's more opportunities probably with the stuff that is higher in demand. And again, you're going to look at that horizontal analysis and look at the trends. So I guess that's where you'll end up using it anywhere you analyze a business or participate in a business. Does that make sense?
Okay. Yeah. So like it would help out a lot with like say like if you're the person over like product procurement or material procurement, like you would then look at other companies and say, okay, do I want to try and purchase our materials from here because they'll be around longer? That kind of a thing?
Sure. Or let's say you're an airline and now you're saying, I need to buy JP5. I need to buy jet fuel. All right. And I need sources for my jet fuel. A, you want to know the solvency of the company, but B, you might try to project prices. It's really hard to predict natural resource prices, but you want to protect yourself too. So you're going to see the trends and barrel of oil has been going up lately. All right. Now, if it continues to go up, interest rates have been going down. And if they continue to go down, again, you're trying to make a best guess with what you're working with. So there are all kinds of trends that you analyze in all kinds of industries for all kinds of reasons. Good question, though. All right. All right, let me play the last 3 minutes. And again, I wish you well. I hope you have a good weekend, and we'll look forward to catching up sooner.
Abercrombie is valued at about, I think it's $1.5 billion, and American Eagle is closer to $4.5 billion. So those are just rough estimates there, but just due to, they're showing that they can sustain profits.
So maybe now's a good time to buy Abercrombie & Fitch.
It's an interesting one, right? Yeah, it does. If you think they're going to come back, it definitely would be a more attractive one to buy.
It's more risky, I would say, but
absolutely.
There's a lot of potential for higher returns. So maybe if you're a younger investor and you have some time to ride the highs and the lows, you don't think they're going to go bankrupt, go for it.
Yep.
But if you're closer to retirement,
like me, maybe on the back.
Maybe you should go American Eagle instead.
That's right. So this has not been giving you investment advice.
This
so if you invest in Abercrombie and lose, don't call me for sure.
But if you invest and win, go ahead and
give us a call. So heads we win, tails you lose.
Yeah, that's pretty much what it is.
Yeah, but we're just touching on it. You'd have to go through an investments class or something to get a better feel for that.
And actually, one thing we haven't talked about is that these ratios are just one piece. Before you make an investing decision, you're also going to want to look at a lot outside of just the financial ratio. So in an accounting course, ratios make a lot of of sense. But you also want to look at market position. What are their plans for growth? Where are they? Things like that.
So
So
basic introduction to financial statement analysis here.
Yep.
So to wrap it up, the key takeaways, creditors, investors, and managers, they're going to be looking at these percentages and ratios in order to make some meaningful comparisons and decisions. When you're performing percentage analysis, if you remember that from the start, we want
Seems like a long time ago.
It is. Look at each account or subtotal as a percentage of that in your sales. Then when you're use ratios in order to compare the company's performance against itself and its competitors, but then understand how to interpret those. They're not always better or worse. They could also be more aggressive or more conservative.
yeah, and at that point, really focus on the interpretation of the ratios, because you can get a computer or some software, some
You can
website.
find them in Yahoo Finance.
Yeah, they're going to be out there, right? So yeah, you need to know how to compute them so you understand what's going into it. But the interpretation, that's the key. Why is something better or worse or more aggressive, more conservative? Knowing that is a key takeaway.
Yep, absolutely. Well, that wraps up our narrated PowerPoint series. This was our longest video. We had to pull it all together. There's probably the most computations and everything to pull into this one. So
All right, that concludes the videos. Thank you for your time. Thank you for sharing. Any questions before we part company?
I guess just a quick comment. Don't forget that homework is due Sunday night because it's a weekend. So,
Good comment, good thought.
because I was just thinking about that too. So,
Yeah, because we had Wednesday off, that was part of the reason why the homework assignments this week were cut back, because we didn't have a Wednesday class, part of our pause days. And so that gave you some more time to catch up, but yeah, don't forget Sunday. I will still say have a great weekend though.
yeah.
So enjoy, thank you. And I'll be here if you need anything. Don't hesitate to reach out.
Thank you.
You're welcome. Stay well. Good weekend.